So there's a ton of videos being put out by people talking about the 50-year mortgage, and there's probably nothing wrong with it, but here's some questions you should know going in, or things you might want to understand, and then questions to ask. Now, if this does become a thing and a 50-year mortgage is on the table for you to finance real estate, a couple things you need to know. Every time you refinance, every time an interest rate changes and you do that, there's a cost. Also, if you're going to be potentially trying to pay this off early, there could be a prepayment penalty, because once they get a taste of this 50-year mortgage, all the interest, I mean, double. If you look at it, the bank at a $670,000 loan somewhere, that interest at a 6.5% over the entire 30 years of that payment is making the bank $800,000. If you go to 50 years, it's making the bank about $1.6 million. Not that anybody's going to be able to go that long. And then, then there's the other question. What happens if you're doing this when you're 50 years old? Are you going to live another 50 years? How does that actually pencil out? And is there going to be some requirement that says, well, you can only get a 50-year loan if you're a particular age? I don't know if that's even the case, but I think it's something to think about. In addition, people are saying, well, why wouldn't you do it? Well, maybe you would, but we got to find out what these costs happen to be, because the people that seem to be so excited about it seem to be the financial institutions themselves and the people that actually loan money, because there's a lot of little extra payments being built into this mechanism. If in fact it does work out, and if the 50-year loan is merely just a 30-year loan being extended to 50 and saving, $500-600 on a $670,000 mortgage, if that happens to be at 6.5% interest, then maybe it's okay. If you can still pay extra payments towards principal every month or a couple times a year and whack that down to 30 years or 35 years, maybe it's okay. But if there are going to be all these little prepayment penalties built in, if there are going to be extra fees for refinancing, if it's going to cost more to get that type of loan because it goes to 50 years and there might be a higher risk, again, you need to see all the numbers laid out on paper with regard to this, and some kind of a truth in lending statement or a good faith estimate or the lender's net sheet or whatever it may be, just something so you can see what these particular charges are going to be from a 30-year to a 50-year. And sure, if you can't fit in a 30-year, if that payment happens to be too much and you can drop it down, $500, $600, $700 per month, or maybe even buy something larger, a larger house, something you and yourselves or your family or whomever going to be more comfortable in, maybe that'll work. You just got to see the numbers. Just assuming that this is all going to be, gravies and licorice. Anyway, gravy and good stuff, you don't assume it. We have to see what those numbers are if in fact this does go to 50, and understand that, people in the capitalist world, there's got to be money made, and we need to see what those costs are actually going to be. Probably not going to be a popular video, but at least for the consumer side of it, you might want to put some consideration on it, exactly what these fees are going to cost, and look at what somebody might redo during a 30-year mortgage. Maybe taking money out might be more simplistic with a 30-year versus a 50-year. Maybe the cost of refinancing are less with a 30-year if interest rates drop than a 50-year. Maybe the origination costs of getting a 50-year loan are going to be a lot more expensive than a 30-year, maybe less expensive because the banks may be making more interest, making that 50-year loan more attractive. You got to find out where those numbers are, folks. That's the truth in everything. All right. I'm Connor with Honor. We'll see you in the next one. Thanks for watching. Be well.